Hey, welcome back. So, imagine being told by the government to fund the high-tech future of the economy, but, you know, instead you take most of your capital and just park it in a giant safe pawn shop.
Right. It's quite the contradiction.
Yeah, and that is exactly the tension we're diving into today. We're looking at how Korean financial institutions are uh, dealing with the immediate shocks of the Middle East crisis while also balancing their domestic loan portfolios and, well, some very vocal shareholder demands.
It's definitely a delicate balancing act right now. I mean, the geopolitical situation is directly impacting Korea, and we're seeing this global volatility force some immediate government intervention. Like currently, Dubai crude is fluctuating around $120 per barrel.
Wow, 120.
Yeah, and to make it harder, the Korean won to US dollar exchange rate has climbed up to the 5,510 won level.
Right. So for folks who don't watch the currency markets every single day, a 5,510 exchange rate paired with $120 oil is just a really difficult scenario for an export-driven economy like Korea. Everything they need to build and manufacture goods just became notably more expensive.
That is the core issue here. And, well, to manage this, there are two major government-backed interventions in play right now. First off, the Export-Import Bank of Korea, or KESEM, is actually adding $540 million to the Korea National Oil Corporation's credit line.
Okay, so bumping that up.
Right, which brings the total line to $940 million. And this is secured at interest rates somewhere between the high 3% to low 4% range.
Got it. So it functions essentially like an emergency household overdraft account.
Yeah, that's a good way to put it.
It just ensures the country can quickly secure crude oil without, administrative delays holding up the purchase.
Correct. The underlying logic there is just speed. But the second intervention targets the domestic side of the economy. The Financial Services Commission announced a 53 trillion won support package provided by five major financial groups.
That's a huge number.
It is, and it features interest rate cuts ranging from 0.8 to 2.0 percentage points for businesses that are directly affected by the crisis.
Okay, wait, I actually need to pause on that point. Because, the government is clearly asking these banks to act as this emergency shock absorber for global crises, right?
Yeah, to support strategic industries.
Exactly. But if we look at the bank's actual balance sheets, they aren't behaving like industrial saviors at all. I mean, they're acting incredibly risk-averse.
Oh, absolutely. The data definitely reveals a stark structural contrast here. At the end of last year, the four major commercial banks held roughly 1,329 trillion won in total loans.
Right.
But, and here's the kicker, 57.96% of that is tied up in real estate collateral loans.
Wow.
Yeah, that's an increase of 0.91 percentage points from 2024. And Hana Bank's proportion specifically crossed the 62% mark, sitting right at 62.08%.
So nearly two-thirds of their entire lending portfolio is just parked in physical property?
Exactly.
I mean, if banks play it safe by relying on real estate to this extent, aren't they functioning more like giant pawn shops rather than engines fueling real economic innovation?
Well, it is a totally valid structural critique.
Yeah.
But, from the bank's perspective, it really just comes down to clear risk management. Real estate collateral is tangible, it's safe.
Right, you can see it and touch it?
Exactly. Whereas assessing the risk for corporate loans in emerging or strategic industries, that carries a much heavier analytical burden and obviously a higher chance of default.
Makes sense.
So real estate is simply the path of least resistance for them.
Okay, so they are optimizing for safety in their lending, but how are they treating their investors at the same time?
Well, they are moving aggressively to reward them. Under the Value Up program, the four major financial groups, KB, Shinhan, Hana, and Wuri, have prepared a combined 31.1 trillion won in dividend resources.
Wait, I need you to explain how that actually works on a practical level.
Sure.
Because the mechanism they're using to distribute this is quite specific, isn't it?
It really is.
Yeah.
They are utilizing something called a capital reserve reduction dividend.
Okay.
Usually, a bank pays dividends from the profits they made their retained earnings, which is, of course, taxable income.
Right, standard stuff.
But here, they are literally shrinking their own legal safety cushions, the capital reserves, and returning that invested capital directly to the shareholders.
Oh, wow.
And because it is classified as a return of capital, it avoids the standard 15.4% dividend income tax entirely.
That is wild.
Yeah, Worry Financial Group has actually already used this strategy to raise its payout ratio to 35%.
So rather than winning a taxable prize from the bank's profits, the shareholders are basically getting a refund on their initial investment dollars.
That's exactly it.
And since it is technically their money being returned, the tax system doesn't touch it. I mean, you can clearly see why folks find that highly attractive.
Oh, absolutely. It's highly efficient for the shareholders, but it really highlights that central tension you mentioned earlier. We
Right.
have highly conservative lending on one side and highly optimized, untaxed capital distribution on the other.
Which leaves us with a final thought for you, our listeners, to ponder. If commercial banks continue to tie up nearly 60% of their capital in safe real estate while aggressively returning untaxed capital to shareholders, which institutions will actually step up to fund the high-risk, high-reward strategic technologies Korea needs for the future?
It's a tough question.
It really is. We started out looking at an emergency overdraft for oil, but perhaps the real shortage to consider is the capital for tomorrow's innovation. That's all for today's deep dive.
We'll be back with more insights.
You've been listening to the Korea Economy Brief, straight from the front page of Seoul Economic Daily. Thanks for tuning in.